All right. Hello, ladies and gentlemen. My name is John Black, and welcome to tonight's financial and wealth management educational call. This call is based on a couple famous quotes you may or may not have heard of before. The first quote is "Own nothing but control everything." That's by the Rockefellers. And the second quote is, "It's easier to fool people than to convince them they've been fooled." That's Mark Twain. Tonight's financial and wealth management speaker is Complex Trust and Private Foundation Specialist Larry Conner. Larry holds a Bachelor of Science degree from Texas A&M and an MBU from NNU. Larry has also worked in the insurance industry for over 30 years and is now retired, educating business owners and families around the world about these uncommonly known financial business strategies. These strategies focus on three main areas. First area is complex trust. The second area is non-operating grant writing private foundations. And the third area is private family banking and financing. Some of these benefits for these strategies are preserve and protect your assets, real estate investor and tax benefits, reduce annual tax liabilities, reduce property taxes and capital gains, avoid probate and death taxes, avoid lawsuits, judgment losses, protecting retirement savings, and also creating generational wealth. Larry will break down the difference between the 1040 tax form versus the 1041 tax form. We'll break down the difference between a grantor trust and a simple trust versus the complex trust. It will break down the operating foundation versus the non-operating grant writing foundation. And it'll also break down conventional banking versus private family banking and financing. We might have, I'm not sure, let me see if we have, I don't see him here. We might have joined the call our enrolled agent tax consultant to answer some tax questions, possibly. But other than that, I'll go ahead and introduce, and it's my pleasure to introduce you, Mr. Larry Conner. Larry.
Well, thank you, John. Now, once again, I come to bring you information. And for those of you that have been on the call before and that have heard the presentation, I want you to particularly pay attention so that you may have questions that you may have questions to ask, that I may answer. I think I got that right. So it's important that when you hear the information, follow up on it and make sure that what it is I am saying that you see, you can recognize, and you understand. And I'm going to give you the points of reference so that you can do that very easily. But my attempt, as John said this evening, is to share with you information that will allow you to develop a financial toolbox and also give you the knowledge on how to use those special tools. And more importantly, what are those tools? What are those tools? So I'd like to start off from letting you know that this information is going to be coming from IRS.gov, directly from their website. You know, there are a lot of people out there doing a lot of things, and they're saying a lot of things, but they're not telling you where it's coming from. We want you to be aware and also see that the information is coming directly from the IRS playbook. Directly is what they tell you to do, line by line. When you think in terms of your taxation, you think in terms of when you have filed your taxes and you receive 5, 10, 20 pages of prepared documents from your CPA or accountant, you know that when you sign, you're saying that I know where every number that's on all of these pages come from and how they were derived. When you say that, when that is said, well, that is not true for most of us. But so therefore, I'm going to share with you a simpler way of doing this by structuring your company as it exists now, or starting a new company so that you can use those tools that are available to you. So starting from the beginning here, if you are on your website or your computer, I want you to go to irs.gov. And doing so, there's a search window. I want you to put in there business structures, because I think this is the beginning of everything. Because if you don't know this, then you don't know where to start. This is the beginning, and this is where you start. from business structures as the IRS has presented. And there is a paragraph consisting of about 4 sentences that makes the difference between whether or not you know what the rules are and whether you don't. So let's just put business structures in that search window. If you have pencil and paper, just make a notation, irs.gov, business structure, and click enter. And in doing so, I want you to click on the first link that takes you to business structures. You'll see the heading says business structure. And then I want you to look at that paragraph. And I'm paraphrasing. The first sentence basically says, choose the business structure or entity you want to establish. So the IRS is telling you to establish a business entity. Then the second sentence says something to the effect, choose the income tax you want to file. So they're implying that there's more than one income tax form, and then you have to choose. At this point, you don't know, except for you know the income tax form you filed in the past. Now, the third sentence says these are the most common business structures. And they start to list the sole proprietorship, the partnership, the C Corp, the S Corp, the LLC. And then it says that choose the business structure or entity that gives you the best tax advantage. Now that's all in that first paragraph, and it's only one paragraph, and then it lists then those entities that use that one form, the one you're familiar with, the 1040 tax form. And here's the key. If you choose any one of those entities, it would automatically default to a 1040 tax form. So, as I've indicated here, there's another form, and as they've indicated, so what is that other form? So I want you to go back up to that search window, and I want you to enter 1041 tax form. Yes, that's the other tax form, 1041 tax form. And then click on enter, first link, click the link, and then click 1041 so that you can get that form. When I say get that form, that means one-page form. Remember, I spoke earlier about you having maybe 5, 10, 20 pages of documents from tax preparation that you have to know where each one of the numbers come from. Then we rely on our CPAs and accountants to tell us that. But on this form here, it's just one page. And we're talking about full disclosure. We're not talking about understating incomes that is generated in any fashion. We're not speaking about taking deductions that are not allowable deductions. So now, on this one page, I want you to know that when you sign this page, you will know that every number that you put on this page are numbers that you know. And those of you on the call, you probably know if someone asked you, how much money did you make last year? And at this time, you don't have to think about how much you got in cash and how much you received in checks. Full disclosure. Someone asked that question, you would know exactly what it is. Now, if someone asked you, what were your expenses last night? I'm talking about in business. You would know what they were. If not, you just look on your tax form and see what they were. Those basically the only two numbers you need to fill out this form. Okay, so let's get started here. I want you first to draw 3 boxes, one beneath the other, on a sheet of paper, and give some space that you can write in between the boxes. Okay, and if you've been on this call before, you're probably a veteran with this scenario. And every time that you hear it, then I'm hoping that you hear something different that gives you that aha moment, and then you're able to translate that in something that's workable for you. Having said that, you got the boxes drawn, 3 boxes. Now, I want you to label the boxes. The first one, business trust. I want you to label the third one, family trust. And I want you to label the third one, family charitable trust. And someplace off to the side, I want you to draw another box and label it private family foundation. So you'll have 4 boxes, but you'll have 3, one beneath the other on the side. Now, I'm having you to do this because each one of those boxes you just drew actually was a replica of the 1041 tax form. We're going to talk about how in this illustration on how to complete that form. and Solomon Jimenez, that's not on the call as of yet, I think, will be available at some point to answer tax questions. But in relationship to this illustration, I want you to see that the tools in your toolkit will allow you to make decisions and do things that you probably had not heard or thought was possible before. Now, before I go any further, I want you to know that this information here, the 1040 tax form and the 1041 tax form, has been around since 1913. They were created almost simultaneously at the same time, which means at the same time, and simultaneously. Now, these two forms, one was meant for the public and one were meant for another group of individuals. And when I say that, it's that you did not have the privilege to glean this information if you did not have a $30 million combination of income, assets, and investment capital. If you didn't have $10 million each in those categories, you were not privileged to this information. And even if you did have the income, someone had to have shared this information with you. And as I go through this, I'll share with you how this information became available to me. But the group I work with spent $28 million over a 4-year period of time challenging the SEC so this information could be presented to the public, in the format that I'm doing right now, and a teaching format, so that you will know. So now that kind of set the stage for what I'm talking about. A 1040, a 1041. 1041 for the elite, for those that are uninformed, or should I say informed, and the 1040 for those that are not aware that the 1041 exists. Two different worlds, and it will make a world of difference in relationship to business. So you have those 3 boxes drawn now. Now, I want you to think in terms of starting a business. I want you to think that the business that you've started can be operated, will be operated directly from the business trust. When I say business trust, business trust is the name that I've given the first box. It is a trust. Each one of these are trusts, and each one files a 1041 tax form. I basically say business trust because if you are in business, you understand how business works. If I use the term fiduciary, I don't want to introduce another term that confuse you as I go through this. So bear with me and understand that business trust is the name I'm using in this illustration for the first box and how it's used. The first box is designed to generate income, okay? It doesn't matter where the income comes from, whether it comes from interest income, capital gains income, ordinary income, income from gross receipts of the trust, but income. It doesn't matter whether it's come from 3 LLCs, 5 LLCs, it doesn't matter. It doesn't matter whether the business trust has multiple income streams, and income is income. So the first box is going to represent income that is received by the business trust. So the first box, if there was income coming into it, and if we said that income was $500,000, and then we said the expense was $100,000, and then we said, of course, if there are expenses, then the net profit in this example would be $400,000. So if you would put $500K, $100K, and $400K in that box. I'm going to try to keep this real simple so that you get the concept. That's the most important thing. The details, I can share the details with you as we go through this and or in a private meeting. So when you look at that 1041 tax form, on line 9, that's the total for income. So that $500,000 would go on line 9 if you're looking at the 1041 tax form. Now keep in mind, this is the publication, this is the tax form, and I want you to write down someplace 1041 publication and instruction, because that is the form, that is the booklet, that is the place you go to fill this 1041 tax form. No different if you went to and pull up 1040 and then you pull up the 1040 publication instructions to tell you how to complete it. The only difference is that the 1040 asked a lot more questions than on the 1041. Same thing, all on the IRS.gov website, not from the internet, but IRS.gov website. Okay, so now that we have the statement that each one of those boxes represent a 1041 tax form. Okay, now we have $500,000 in there as income, And I want you to circle, if you have a 1041 printed out on your computer, or just write it down, 15A. Put it on the left side of that box, because that's where the line the expense go on. So far, we only put 2 numbers in it. So those 2 numbers, you guys know where it comes from, okay? And full disclosure, it doesn't matter whether it comes from a foreign income generating entity or whether it's not, it's an offshore. Income is income. Full disclosure, okay? Now, I want you to write to the right side of that box, 39.6%. Just the right side of the business trust, 39.6%, because that's the income tax rate that will be assessed to income that remains within the business trust at the end of the year. Now, sometimes if a business person saw 39.6%, they would stop right there and wouldn't proceed any further. But stick around, it'll make a difference to you. Now I want you to write EIN under that 39.6%, because the EIN number here says Employer's Identification Number. I want you to understand that this business trust is a person. It's an artificial person. It is a separate taxable entity. The IRS will send you a form, an SS form, saying that we have established this trust. You are the trustee. This is the trust address. This is the employer's identification number, and you must file a 1041. Now, when we say file a 1041, I've showed you the 1041. We've already started on completing that form, but I want to bring to your attention is that at the top left-hand side of that form, you must mark complex trust. If you don't mark complex trust, or if you mark something in addition to that or other than that, everything I'm telling you will be incorrect. That's how strong and powerful marking complex trust is with the information I'm telling you. Okay, let me just get back with it. Now, under the EIN that you've just written, under the 39.6, I want you to write 1041, because as you look at this example again, I want you to be reminded that the box there is a replica of a 1040 tax form that has income deductions on it, okay? Now, after 1041, I want you to write down line 18. Line 18 is how we're going to use this 1041 tax form in relationship to the second 1041 tax form that you have labeled as a family trust, okay? Under line 18, I want you to write the word trustee. Now, trustee is who you are. You are the person that, the real person that handles the affairs of the trust. You occupy the position of trustee. You do not own any of the assets or the income generated by the trust or any asset placed in the trust. You do not own it. You simply control it. Now, in this process, every dollar that is spent for business purposes is an allowable deduction. And so in this case, 100,000 from 500 is 400,000. Now, 500,000 came into the trust, 500,000 went out, creating a zero tax liability. Now, if you're looking at the form, you see where it says line 9, and you see where it says line 15A, and then that 400,000 will be placed on line 18, because the trustee now has the responsibility to determine what's going to happen from a taxation standpoint. Will it be taxed at 39.6%, or will the trustee exercise his or her option to distribute part or all of that income to another taxable entity? In this illustration, we're going to show that the trustee is going to distribute 100% to another taxable entity. So in other words, that tax liability of 400,000 passes on to the business trust. Now, I want you to draw an arrow from the business trust, from the bottom of the business trust to the second box. Now, this arrow simply implies that $400,000 has been distributed to the family trust. And I want you to write K1 to the side of that first arrow, because that form is what tells the IRS who is going to now be accountable for that tax liability. Now, 400,000 is income to the family trust, so where would it go? Just like in the business trust, it would go on line 9. Remember, this box is a 1041 tax form. I'll say this many times. I want you to understand they are separate taxable entities, just like you're taxed separately from me and I'm taxed separately from John. That's how separate it is, even though you are the trustee in each case. Now in the family trust, you have 400,000 as income coming from the business trust. There's $100,000 I'm going to use in this example as the expense deduction. So the expense deduction leaves $300,000 as net profit or net income. That $100,000 is for any dollar that the trustee used to purchase anything in behalf of the trust, whether it's purchasing real estate, whether it is purchasing other assets, etc. And we can get through that in more detail later. But at this point, remember that net income of $300,000 now goes on a separate line different than that in the business trust. That $300,000, I want you to write the word line, L-I-N-E, 13 to the right of that second box, because this is how this box is going to be used in comparison to the business trust. Now, I also want to let it be known that that information you wrote on the side of the first box, 39.6% EIN, 1041, line 18, and trustee, that same information applies to each one of the boxes, the family trust, and the third box, the family charitable trust. At this point, I'm just making a notation of that in your mind and for the call, but I want you to know that line 13 is the difference on how it's used. If you're looking at the income tax form, the 1041 income tax form, line 13 refers to charitable deduction, okay? So whatever is on that line is the amount that is going to be donated to a charitable entity and take a full deduction for it. So the trustee, once again, decides that he has the option to donate part or all of that to another taxable entity, which is a charitable entity, the family charitable trust. So he or she donates 100% as their option. In this case, $300,000 goes to the third box, which is the family charitable trust. Now, in the example, $400,000 came in from the business trust, $100,000 went out as expense, $300,000 is the net income, and also the same dollar amount that was donated to the family charitable trust. The family charitable trust now has $300,000 in it, and if you notice, I'm going to use again $100,000 as expense. It can be zero. It is whatever it is. Whatever your accounting, your bookkeeping says it is, that's what it is. Income in this example is based on $500,000 coming into the business trust. Now, $100,000 as expenses, each one of the trusts are separate, and each one can do the same thing as the other trust. In this case here, the Family Charitable Trust, it is going to donate its net profit or net donation to a private family foundation. Now, you drew a box on your page someplace, and now I want you to draw an arrow from that last box, from the third box to the fourth box. And I want you to put $200,000 in that box, because at that point, the $200,000 now has been donated from the charitable entity to a private family foundation, okay? Now, I want to go back and recap real quickly, and so we'll move on because there's a couple of things I want to talk about as well this evening in relationship to your tools. So the business trust receives the income, and it takes all its legal lawful deductions and pass on a net profit to the family trust. The family trust receives that income, takes all of its legal lawful deductions, and then passes that difference off in the form of a donation to the private family foundation. The private family foundation receives that donation from the family trust, and now it takes all of its legal lawful deductions and donate the difference or that net donation to the private family foundation. Now, those three boxes when set up, becomes a federal entity, not subject to statutory rules. Its records are private and not subject to subpoena. This is a confidential scenario or environment that the trustee has. The trustee, when he passed or resigned, and let's use the example of that he passed. If he passed, he would have chosen a successor trustee that steps in and takes over as though he's still there, which means there is no estate tax, no probate tax, no inheritance tax, no death, none of those taxes that are associated with your estate, because it's no longer your estate. And there are no attorney fees, okay? So you have a system that allows you separately and independently. Now, one of the questions I'm asked is, why are there three separate boxes? Why can't you use one? Well, when you're talking about business, you want to be able to separate business assets from assets that are not business. You want to be able to protect the assets that's in each one of the trusts. So whatever happens to the business trust has no effect on the family trust. Whatever happens on the family trust has no effect as to what happens in the charitable trust. So they're independent of each other. The first one generates the income. All other expenses are handled out of the family trust. The family charitable trust handles all your charities, and the private family foundation handles all of your nonprofit type stuff. Now, let me talk about that private family foundation. One of the things I want you to know off the bat, that there are two basic types of foundations, okay? And one that can donate 50%, that you can donate 50% personally to, and one that you can donate 30% personally to. Now, and take a deduction for it as well. I want you to write down operating foundation, 50%. Operating foundation, and then write next to that 50%. Then I want you to write non-operating foundation and write 30%. Okay? Now that you have written that down, the difference is this. 98% or more of the foundations that are out there, primarily held by, athletes, movie stars, entertainers, are operating foundations, where they're able to take a larger deduction by giving up to 50% of the adjusted gross income to a operating foundation. But the operating foundations has a lot of restrictions. It tells you how to pay employees, that you must take income and must distribute all of the money by the end of the year and start all over again the next year. And there are a lot of restrictions. However, with the non-operating private family foundation, or the non-operating foundation, it allows some things that are different. So here's what I want you to do. I want you to draw some arrows, 3, 4, 5, to one side of the box. And all of this will represent is that it can receive donations from anywhere. It can receive donations from a charity, which it already has, from the private, from the family charitable trust. It can receive donations from other individuals. It can receive donations from foundations, from corporations, from the federal government. This is only to let you know that it can receive from anywhere. But in this example here, it shows that $200,000 came from a charity. Okay, so let me kind of give you an idea on how it works further. Let's say, for instance, all of the donations it received was $1 million, including the $200,000 that came from the Family Charitable Trust. Now, in this foundation, private family foundation, the trustee controls everything. So the trustee decides to buy $800,000 worth of interest in an apartment complex, and which means the apartment complex means that it has rents, and that rent comes to the foundation, whether it's $5, $10, $50, $100,000 a month, comes back to the foundation without any tax consequences, tax exempt. Now, that real property in most of the counties in the United States is tax exempt, which means no property tax in most of the counties. Now, also, the assets of the foundation are not subject to lawsuits. So we have a foundation so far that assets are not subject to lawsuits. Real property does not have property tax in most of the counties in the United States is exempted, and income comes into the foundation tax exempt. Well, we have $200,000 left. So in this example, $200,000, the trustee decides he wants to invest in other businesses and other income-generating opportunities. He wants to invest in program-related investments or whatever the scenario is. And let's say he wants to invest into the business trust where you, the trustee, are. Now, you're also the trustee of the private family foundation. Remember, you don't own any of the assets in either one, so therefore double dealing and all of that kind of stuff is out the window. You're investing in a business to generate income, that income may come back to the foundation tax exempt. Now, one of the things I want to mention is that the foundation can own whatever you own. If the foundation owned a life insurance policy, then it could pay the premiums on the life insurance policy. If the foundation owned that life insurance policy, it paid a premium. That means that life insurance policy is not income. It's an asset. It's an asset to the foundation, which means that if it's a whole life policy, it generates cash value. It generates cash value, and it grows at whatever rate the company that you work with has illustrated for you. The beauty about this also is that you as an individual, you can donate up to 30% of your personal income to that same foundation, which means that if you had an income of $100,000 and that was your adjusted gross income, 30% of that would be $30,000. That's the $30,000 now that would be donated to the foundation, and you will take a $30,000 deduction, and at the same time, the foundation now can continue to operate, pay the life insurance policy, pay the administrative costs, whatever they are, out of that $30,000 donation. I've given you an example here where you can control from the beginning of income all the way to the end. You control all of the income. Now, one of the things I didn't mention was the 5% that's accountable for the foundation. In the operating foundation, 5% must leave the foundation to a tax-exempt entity or nonprofit, etc. But in the non-operating foundation, the 5% is to help grow the foundation. When we talk about help grow the foundation, we're talking about 5% of that. If $200,000 came over from the charitable trust, and 5% of that is $10,000. So you have the responsibility as the trustee to grow the foundation by at least that 5% or $10,000. What are the things that constitute that? Premiums paid to life insurance, administrative costs, family retreats, the cost of doing business, operating a car. All of those things come into play and satisfies that 10% requirement or 5% requirement or $10,000 in this example. Yeah, I've been talking for a minute now. So what I'm going to do, excuse me, is to let you know something about when I said life insurance. When I say life insurance, it just may have just rolled off of your back and say, okay, just another asset, just another something that the foundation can own. But the reason I said that also because when I talked earlier about financial toolbox, when I talk about the knowledge that how to use special tools, well, the special tool here is the 1041 tax form. Now, one of the other tools in the toolbox is a life insurance policy, a whole life policy. Whether or not it's whole life, whether it's index life, you decide and you get with your agent and determine on which one works best for you. But the case is here is that I want you to look at life insurance a little differently. Yes, I am licensed as an insurance agent, and I just want you to know that when life insurance is sold, most of the companies out there sell it as death insurance. When you die, what's going to happen? No, we want you to look at it a little differently. We want you to look at it as banks look at it. We want you to look at whole life insurance or life insurance as corporations look at it. A tidbit for you. Did you know that banks are one of the largest purchaser of whole life insurance? Corporations also. So what is it they know that we don't know? So what we're talking about here is that taking that 400 to 1,300% they make off their loans and investment and financing, we want you to understand that these same kind of numbers can be yours also in creating your own private bank. And to get private family financing, you must have your bank. When I say your bank, a bank can be, it doesn't matter how much money you have. You can start a bank with a penny. Yeah, I think maybe today you have to have a little bit more than that. But the point is that when you are trained on how to fund that bank through using a life product, how to fund that bank and use those dollars to buy the things that you normally buy while your money continues to grow compounded annually, you will learn a different way on how to use the tools that are available. And we will share with you later in more detail on how to make that happen. So to recap is that the financial tools in your toolbox would be the trust, the foundation, and how to use a private family financing through a private family bank. Whether or not the foundation owns it, or whether or not the trust owns it, or whether you own it as an individual. The key now is to take control of dollars you used to pay someone else in interest, and now that you can learn how to pay that back to yourself and receive that. So it is my intent and my wish that you receive the knowledge on how to use these special tools and to understand that everything that I've told you so far is based on contracts, is based on trust and forms. So at this point, I'm going to stop. It's about 20 till, I think, and I'm going to allow you to ask questions. The floor is to whoever wants to ask the first question.
Good evening. My name is Abiko Hinio.
Yes.
Yes. I have a question. I have a process that basically a fuel source that I'm looking to monetize and essentially create a bank. Essentially what it is I'm going to taking water, passing electricity through it, and I use it in internal combustion engines. I've been doing this for over 7 years, and I've been getting anywhere from 15 to 60% improvement in gas mileage or work done. And what I'm looking to do is monetize that and turn it into a liquid capital account, ideally, a trust, and then by extension, a group that I want to work with, and and just take it to where we're doing international, business, global business.
Okay, I missed the question.
Essentially, just with what you're talking about, would it be something that I could? Essentially, I'm looking to monetize it and create a bank.
Okay. Well, first of all, you're speaking about a company. So you'd have to establish, and if the company is a manufacturing type company, that means you're going to have employees, and that means that we would want you to create an LLC to handle that manufacturing, also to handle the payroll for employees, et cetera, because we don't want that within the trust itself. So once that LLC has been established, that's your business entity, okay? Your business entity generates the income, and that income passes through from that LLC to the business trust. So from that standpoint, everything that I've just told you comes into play once the income gets to the business trust. In your case, the money would not come directly to the LLC. To the business trust, because it is being generated primarily by the LLC. You're just making the trust one of the members of, or the owner within the business trust. The LLC. LLC is going to have two members. Members are considered owners by the IRS. So there will be two, yourself and the business trust, for example. So within that ownership relationship, you have a multi-member LLC. You manufacture your product. You take all your legal lawful deductions, and the net profit is divided between you and the trust based on whatever percent you set up in your operating agreement. It can be 2% for you and 98% for the trust, or whatever combination that you choose.
Mm-hmm. All right. Thank you.
You're welcome.
And then also, too, Larry, in regards to his question, he's monetizing and making some money off of his product and services, so he can take that same money and put that into the financial tool, the life insurance policy, to grow that money for his own bank. Correct?
Absolutely, absolutely. See, one of the things that we're talking about here is that we tell you how to. You make the money. We show you how to keep it. We show you how to protect it, and we show you how to be involved in the community, and also to grow money to leave a legacy for those that follow. But one of the things that when you generate the money and the income, one of the places to put it to help it grow that is protected is in a contract place that gives you guaranteed returns, and also those guaranteed returns come in the form of income coming from any business. It can come from your 401k. It can come from your annuity, a self-directed IRA, and those are places you need to stop and think in terms of how much have your 401k grown in the last 5 years. If you had $200,000 in your 401k now, but you had $300,000 last year, or maybe if it remained the same. Now, would it behoove you to put it in an entity that is going to grow 4% minimum compound annually? So we're talking about sources, just minimum source. So the question is that would it behoove you to take a penalty if you're less than 59.5 and take those dollars and use it in a different way to grow cash? To grow cash. That's what we're talking about. Moving money to grow cash. So if you're 59.5, you don't take a penalty. You just pay the taxes on whatever the taxes are on the money that you take out. And so we can work with you and show you that if you take the hit on, when I say hit, the penalty, if there's a penalty, or if you take those dollars out, how it will far exceed the traditional 401ks that you may have out there. One of the things that I was introduced to a few weeks ago was that 401ks are guaranteed to do one thing, not to go below zero. And there are some cases where it has gone into the negative. So my point is that don't get so hung up on penalties and paying taxes on assets that are not moving, that are not growing. Take it, get out, recoup. I just thought I'd add that part in.
And also, too, in regards to that cash growing, that same cash can be used as well.
Right. And what John is saying is that when you have the type of product that we're talking about, and you have $100,000 in cash, it doesn't matter whether it's $10,000. The point is that if you make a deposit that year, and if the deposit was $100,000, then 30 days after making that deposit, you can take out $55,000, and your 100 is still growing at 4.5 compounded interest. So these are just details associated with the product. The intent was not to get wrapped up in all of the details associated with the product, but to let you know that think about life insurance differently. When someone comes up to you and refer you to a process that will allow you to grow your money, keep your money, spend your money at the same time, and I say your money, I'm talking about your money and also the money of the trust that you're the trustee of. Any other questions?
Hi, my name is Bev.
Yes.
Hi, I was, since this is the first time on this call, some of the information you said went over my head. Is there a way I can get the recording of this?
Absolutely. John is going to make sure that everyone on the call that wishes to have this recording, that he'll also send you a flow chart if he hasn't already. He'll send you a recorded call, and then if you have additional questions, he can also set up a personal contact with me so that we can talk about your scenario individually or privately. And that goes for everyone that's on the call as well. You're very welcome.
Hi, my name's Orlena Mejia, and I wanted to know the things that you were talking about regarding the trust and everything, how it applies to property outside of the country, and what are the stipulations with all of those types of things.
Well, see, a very good question. Ownership is ownership. It depends on who owns it. The trust can own property in the United States. It can own property out of the country. So if the trust buys the property, owns the property, receives the property as a gift, title to the trust, then it is owned by the trust. Any income that's generated, if it's rental property or commercial property, that income comes to the trust, and it's followed the same process as we just talked about and how income and expenses and distribution works. Did I answer your question?
Yes, you did. Thank you.
You're very welcome. Any other questions? And speaking of out of the country, when this trust system of interconnecting trust is set up, it becomes a federal entity, as I indicated earlier, and it can operate in foreign countries as well. Any income you have that's being generated through offshore accounts or entities or industries or wherever income is being received or generated, the trust can receive it and handle it in the way that I indicated earlier.
Is that based on what you put in your trust resolutions?
Say that again.
They're going to be based on what you put in your trust resolutions.
Okay, that's okay. Make it a question.
Well, you said that you can own property and do things anywhere, but that's based on what you put in your resolutions, right? What your trust.
Well, here's
is.
Okay. The trustee can make decisions to do whatever, but when it comes to property, if the trust buys the property or if the trust has been signed as a result of a quitclaim deed, it is now titled to the trust. So therefore, once it's titled in the trust, that means it's registered. You're registered in the county. Would you make that a part of your trust resolution in minutes? Yes, you would. And that's just for record-keeping purposes because the county would have it listed. You would also have it listed in your records and resolutions. Absolutely.
Okay. And basically, our trust constitutes. Basically, we're going to say what our trust can do. I got two questions for you, and I was trying to get back to the people last week so I can get connected to everybody, and I couldn't. But I'm going to see can we make it work this week. One of my questions is, in this system, does income only come into the LLC, or can income come into the trust, the business trust?
I did. I worked with the gentleman on yesterday that set the system up, and $150,000 a month is coming directly into the business trust. So the business trust can receive it any kind of way. And all I'm saying when I spoke of the LLC is that if you don't have employees and you're not concerned about the name of the company, you have passive income, That passive income now can become income that's received by the trust if it's titled to the trust. So
Understand.
Okay, great.
Understandable, yeah, and then you can still operate in the public through that LLC comfortably.
Sure.
Understand.
Sure can.
Okay,
Yeah.
and I guess my next question for you is when I speak with you guys are going to ask, what if you already have a business trust and already have a charitable trust, but you don't have a foundation? Will you guys at least do that part for us?
Absolutely.
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 Oh, okay.
You know, when I started the conversation, I talked about the toolbox. You know, when you're first getting started, you get out of college and you get your first apartment, and you go to put up your blinds, and you realize that you have a flathead a screwdriver and you need a Phillips screwdriver. So you go to the store and buy a Phillips screwdriver, and then you come back and you say, man, I should have got a pair of pliers. So basically, if you have the business trust and you have the charitable trust, that's part of the toolbox. So when I speak in terms of the series of interconnecting trusts and the foundation, I'm talking about the whole toolbox, which means that everything that you want to do, you can do it within either one of these four entities.
Exactly, and because I will say that it's been kind of taxing because I've been thinking that most of that resources had to be taken offshore and all that, but in this structure, I see they can stay right on the state side.
Absolutely, absolutely. Any other questions? These have been great questions.
I have another question.
Sure.
So would you already have a corporation already in place? I'm not sure if you answered this already. Would that kind of mess up the pie of what you pretty much need in order for you to, set up a trust or anything of that nature? Or because I hear you talking about LLCs a lot, but would a corporation be able to blend with that, or what?
Well, here's and that's a very good question. When we talk about the C Corp, the S Corp, you can have an LLC that files as a corporation. So if you have a C Corp, yes, it can be used to, as you say, to blend with the business trust. But if you have an S Corp, that is something different because the IRS gives restricted rules to an S Corp because basically what they've done is that they've watered down the C Corp so that double taxation wouldn't come into place and it could be a pass-through. So it responds to trust in this manner from when it comes to the S Corp. It says certain trust, but it does not delineate what type of trust. So for that reason, we do not operate in the gray. So if a person has an S Corp, our enroll agent, which is a tax specialist, he converts those, not transfer them, converts them to an LLC. And the reason we use LLCs is because an LLC is not taxed. Only the members are. And the members' income flows from the LLC to the taxable entity, whether it's yourself or whether it's to the business trust. Now, when it comes to corporations, can a trust be a shareholder in a corporation? Absolutely. There are some circumstances where you have to have a corporation. If that's the case with you, yes, we can work with you on that as well.
Okay, so if you already have one in place, basically you'll be able to maneuver things around to be able to fit into what you're already talking about right now.
Sure, and we can work with you and to let you know what is the best way of doing that as well.
Okay, great. Thank you.
You're welcome. Any other questions?
Hi.
Hello?
So I have another question.
Okay, go right ahead.
Yeah, sorry. So regarding any consultation or being able to get together on a one-on-one basis, how do you go about doing that?
Well, whoever brought you to the call, they will get in touch with John, or John, if he's available, he can recognize who you are and reach out and arrange a time that we can talk with on that one-on-one as you need to.
Okay. Are you in the Bay Area, or?
I'm in the Midwest. I'm in the
Okay.
Midwest. So I was just out there at a conference with John. Last month? Last month? Yeah, last month.
Okay.
Yeah.
Okay.
You want to address that, John, in terms of those individuals that
Yes.
have questions? Yeah, go right ahead.
Yes, and we'll get, and I know who they are. I spoke with them earlier, so I'll make sure
great.
that we get them on a call with you. I'm out here in Northern California, in Folsom, California. I spoke with you earlier with Hassani, so I'll make sure that we get you guys hooked up.
Okay, thank you.
Very good. Any other questions?
Do you guys file the taxes on the 1041 as well?
We work with a team and a group of individuals, and one of the guys that work with us is an enrolled IRS agent that is a tax specialist that work with our group. To answer your question, yes, we do. We can. Okay. We can handle the 1041s as well as the your personal or your corporate ones, and also restructuring from a corp to an LLC or from an S corp to an LLC. Or creating an LLC. We have members on our team that specialize in each of those categories.
Y'all being, one of the things I was looking at, the rules have kind of changed a lot. Are y'all being selective about what states? I didn't hear you talk about that as far as, still looking for maybe some privacy.
Well, see, here's the thing. Now, when it comes to privacy, it depends on how you define privacy. A lot of times when people say privacy, they really don't mean private. They really mean that I want to separate myself from those things that are assets to me so it doesn't draw attention to me. The trust creates that by allowing you to give up what it is that you own that is titled in the trust so that it's not titled to you. However, on the other side of privacy, if you had an LLC and you were the organizer and the trust was a member and you were a member, if that was done in Nevada or Wyoming, in one of those states where the organizer's information is confidential, that would give you privacy. No one would know. But at the end of the day, regardless of what state you're in, it really doesn't matter because the trust will own what it owns. Its income will be whatever income it is, and it will follow the system that I just showed you. And your income would be whatever it is, and will follow the 1040. But yes, to answer your question, there are ways for it to be confidential.
Okay, great.
I have another question. Hi. So I have a couple clients actually that has kind of like tax situations going on. Would their taxes basically have to be cleared up in order for them to, deal with a situation like this as far as getting trust and things of that nature? Or like, how would that work?
Well, one of the things we do is that we keep everything is above board, and our enrolled agent that works with us would be a good idea for him to talk with the person that has this issue, and so that maybe he can find some ways because of his 26 years of being in the business and being familiar with this structure might be able to help further than perhaps his account that he has now. Not saying that that's the case. However, if you're engaged in an issue with the IRS, the first thing you do is to settle that with them. When I say settle that, if they say they owe you blah 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 and you agree to pay whatever that is, that means you have a satisfied agreement with them, and then we do the trust. If you do the trust and move stuff before that is set up, it could be considered a fraudulent conveyance, and it could take all of that back and create a whole bunch of problems for you. You don't want that.
Right. Good to know. Okay. Good to know. Good to know.
But also keep in mind, our enrolled agent is fabulous in regards to, well, you don't know this, but I'm letting you know that he's very good in regards to helping clients with issues and getting them rectified in certain ways that you probably wouldn't, be able to do on your own or through even another tax specialist. So I highly recommend you speaking with him as well. And this is Bev and Orlana, right?
Yes, exactly. I have a couple of clients that are going through some tax situations right now, and I'm currently looking for somebody that could actually help them. So I think this would be a good avenue to have some money available so they can start investing and doing other things.
Absolutely, absolutely.
Wonderful. This has been a really great call.
Very good, very good. Are there any other questions?
Question. Can you speak to the grant writing aspect of things? You mentioned that in the beginning of the call.
Well, when we talk about grant writing, if you're an operating foundation, you're looking for someone to write a grant for you so that you can get funds within the foundation to do and carry on a specific purpose. But when you're a non-operating foundation, you can pick a source that you want to provide dollars to. And I say you can pick. When one is selected, then you can write a grant for that out of the foundation, tax deductible to the foundation, without it being repaid back to the foundation. So you have a group that is part of the interest that you're interested in, and you want to write a grant for $25,000. I say you write a grant, and you want to fund that issue through the foundation in the form of a grant. You as trustee can do that with the foundation, with the private family foundation. And obviously grants are not it's not considered taxable income, so that party does not have to pay it back, and nor are they taxed on it. And one of the other things too that is different between the non-operating foundation and an operating foundation when it comes to grants is that if a grant is provided by the private family foundation, once it is given, it no longer has a responsibility to keep in touch with them or on track with them on how they use the funds. That's totally up to them once they receive it. That is not the case with the operating foundation.
So this foundation is non, right? It's a non-operating.
N-O-N, non-operating foundation. Non-operating grant writing foundation.
And it doesn't stop people from donating to it because it's non?
Oh, no. You can receive donations from anywhere.
And it doesn't stop you from operating nonprofit programs like the prison reform program and stuff we're trying to do. It wouldn't stop us from operating that, or would that need to be a 501?
No, well, I'm glad you said that because I failed to mention that when we talk about foundations, you can have a foundation that is not tax exempt. When I said that the real property was tax exempt, that meant that it had a 501c3 determination letter. A 501c3 only means that the entity has tax exempt status. Yes, it is a 501c3, and it can be considered a nonprofit. No different than the NFL is a nonprofit, and it's also as a foundation, which means that they made $15 billion last year in a nonprofit.
There we go.
Great.
Any other questions? Well, John, I guess I'll give it back to you, sir.
Okay. Well, thank you very much, Larry. Thank you for your time and expertise and educating us this week and every week. I've been working with Larry for the past 4 to 5 years doing this every Wednesday when we can, unless there's something that comes up. But definitely feel privileged to share this information, and we keep learning more and more things every week, every month, every year, and growing with our network. So I want to thank all the ladies and gentlemen for coming to the call tonight. If you would like to get back with Larry and have a one-on-one with him, get with me if you have my contact information, or get back with the person that sent you to the call, and we'll make sure that we make that happen for you as well. And I will also send out a recorded call for tonight's call to the people I sent the invite to, so they can get that to you as well. In that email, there is a questionnaire in the email with the attachments, and that questionnaire will be completed and sent back to Larry if you would want him to review your current situation. Other than that, thank you once again, everyone, and we will have this call again next Wednesday at 6 p.m. Pacific Standard Time. So thank you once again. Good night, and God bless.
Good night, everyone.